Good morning. My name is Connor Marinan, and I am the Editor-in-Chief of the Journal of Law and Public Policy. It is my privilege to welcome you all to our fall symposium, Shield and Shackle, Retail Banking and the Outgrowth of Financial Regulation. This symposium is a culmination of months of planning and hard work by all of our editors and presenters, and I want to thank everyone for taking the time out of their busy schedules to be here with us today. The Journal of Law and Public Policy is one of the school's 2 law journals, and the charge of its staff is to present a platform for discussion and analysis of policy issues. We do this chiefly through our semi-annual symposia and the publications that result from these symposia, in an attempt to provide a forum for critical examination of issues in current law and policy. In keeping in line with this goal, we are very much looking forward to today's discussion on the robust financial regulation in retail banking, particularly as we look at the Consumer Financial Protection Bureau and the growing impact it has on both the industry as well as us, account holders and consumers. The JLPP is grateful to our presenters and the opportunity to look deeper into how robust financial regulation impacts public policy within the United States. We are extremely fortunate to have a distinguished collection of speakers here with us today to discuss this timely topic, including Professor Robert Craner from the Wisconsin School of Business at the University of Wisconsin-Madison, Professor Paul Schultz from the Mendoza College of Business at the University of Notre Dame, Greg Polis, former General Counsel of TCF Corporation and Board of Governors member at the University of St. Thomas School of Law, and lastly, Joanne Barefoot, CEO of Barefoot Group and Senior Fellow of the Mosvar Ramani Center for Business and Government at Harvard University. We hope this forum will provide a platform for speaker and audience discussion on these topics. And so to that purpose, please jot down any questions you may have on the cards accompanying your program. We will collect them, and a JLPP member will moderate the question and answer session following each speaker's presentation. So we'll move right along to the first introduction of our first speaker, Professor Robert Craner. Professor Craner is a professor of finance, investment, and banking at the Wisconsin School of Business, and his research focuses include banking cycles, corporate finance, and financial markets. He earned his PhD from the University of Michigan and held a postdoctoral fellowship at the Department of Economics at Harvard University. Professor Craner has published multiple scholarly articles in journals such as the Journal of Finance, Journal of Political Economy, and Journal of Financial Stability, among others. He has been on the faculty at the University of Oxford and was a visiting scholar and foundation fellow at the Banque de France. Please join me in welcoming Professor Robert Craner.
Well, thank you first for inviting me. I'm going to start out on something you might know. It turns out that we are midway through the movable Feast of Sukkot. Does anyone know what the Feast of Sukkot is? Well, it's known as also the Feast of the Tabernacle, and it celebrates the Exodus. It was the first stop after they went through the Red Sea. You may say, well, so what? Well, there happen to be 2 accounts of Jesus cleansing the temple of bankers. They say, there's Matthew, Mark, and Luke. They all had the cleansing occurring during the last week of Jesus' life, during Passover. And then there's John, 2nd, verses 13 to 17, had the cleansing occurring right after the wedding at Cana. But there's no date when that wedding took place. However, there was a Catholic scholar, Monsignor Charles Pope, that did exhaustive research that found most of the weddings at that time occurred in September, right after the harvest and right after the vintage. Hail is, of course, will return the water into wine. Okay, so we have the possibility of two cleansing of the temple. And it's not unreasonable to think that the one that John talked about took place during Sukkot. And again, that's a movable feast that takes place anytime between the end of September and the end of October. And during Sukkot, devout Jews also had to pay a temple tax in temple currency. And the exchange rate was awful. That's one of the reasons why Jesus drove money changers out. Now, so it's not unreasonable to think that Jesus drove these money changers out approximately 2,000 years ago, and perhaps to this very day. So we are today continuing consumer financial protection that he started at that time. And with that, I'll sort of begin. Okay, that's the outline. This is a big subject and can't be covered in a short time, so I may actually skip parts of it. But I must start with the financial crisis, a short history at any rate, because that's what brought on this. Okay, the crisis of 2007, many people dated 2009. I think it went further. And what goes up must come down. Causes of the expansion, so what caused the upside? Well, government policy towards housing. Every person should have a stake in the country, no matter what their income group. And Congress wanted to make that happen, and they did in a number of laws. More important, I think, was the easy monetary policy from 2002 to 2005. M1, which is the sum of deposit money, checking account money, and currency, increased on average 5.2% per year, reducing interest rates, and that stimulated the demand for housing and other investments. Another factor was a savings glut, the world savings glut. We had massive deficits, balance of payments deficits, and those deficits ended up in our market, much of them into treasury securities, but they drove the rate of interest down on treasury securities, and everything sort of aligns on treasury securities. So that reduced rates too. Rising share prices in general, and rising bank share prices in particular, reflecting a fall in the risk aversion of investors. Bank share prices rose on average 7% for the period 2002 to October 2007. This reduced the cost of capital of banks, that in turn enabled them to make more loans. It also reduced their risk, so they took on more marginal subprime mortgages. A number of authors point to the hubris of bankers. Whether that's true or not, I really don't know. All of the above contributed to this run-up in residential and commercial real estate valuations. What I would call a facilitating cause, which I'll spend some time on later, are these contract forms that came into being. Actually a little earlier, during the run-up, in fact even earlier than that. Adjustable rate mortgages, the 228 mortgages, where for 2 years you got a fixed rate that was low, and then for 28 years you had a variable rate mortgage, which was generally higher. Various forms of backloading the mortgage contract. Evidently, you're able to push principal and interest in the future. Hence, it looked in the beginning like the house would be cheap. Low down payments was another factor, and there was a lot of fraudulent stating what the down payment was, mainly through increasing the valuation of the residential property. Securitization and tranching, that occurred in the 1990s. They created securities that were hard to evaluate. So they gather mortgages together into a portfolio and then slice and dice the portfolio into various tranches. Those tranches proved to be hard to evaluate by the rating agencies. Now, what caused the collapse? All this sort of caused the increase in economic activity and the housing market in particular. Housing prices were rising very sharply. Well, M1, money one growth went from an annual average of 5.2% in that 2002-5 period to a minus almost 0.25% from 2005 to 2007. That raised interest rates. Higher interest rates reduced the demand for housing, which reduced the rate of price appreciation of housing assets and eventually led to a fall in the price of housing assets. Okay, because of this low down payment, the various forms of this backloading of the mortgage contract, the run-up ended up, or during the run-up, many homeowners found that their equity in the housing assets became negative and just walked away from their house. Gave it to the bankers sold it. The forced sales of housing assets from defaults attenuated this decline in the housing market. Stock market valuations declined sharply too. In fact, more so than housing assets. Another cause of the collapse was refunding difficulties of shadow banks, for example, investment banks holding the tranches of these risky securitized real estate assets. And they had high leverage ratios too. Some went bankrupt, like Lehman. Others, like Baird and Merrill Lynch, were merged into stronger banks, and still others became banks. Goldman Sachs and Morgan Stanley became banks so they could access Federal Reserve funding. Money market mutual funds, in a flight to safety, stopped buying commercial paper. And at least one of them broke the so-called buck. Everyone stayed away from buying commercial paper or engaging in repo transactions with the investment banks or any banks. So the Federal Reserve had to step in, and they set up a commercial paper funding facility in October of 2008. The end result is the whole financial system was freezing up and unable to perform its financial intermediation function. As I said, the Federal Reserve did part of it through the commercial paper funding policy. What were the sequence of events then? Well, there was the collapse in the valuation of housing assets. Now, what's important about that? Well, in this Anglesey study, the marginal propensity to consume out of the change in the valuation of housing assets is 0.07. For every dollar decline in housing assets, consumption fell 7 cents. The same held true for the stock market, although a little bit less so. The marginal propensity to consume out of the change in the valuation of financial assets was 4 cents. For every dollar that declined in the markets, there was a 4-cent decline in consumption. So firms responded to this reduction in consumer demand by cutting production, cutting investment, and laying off workers. That was the crisis. The magnitude, well, it was really quite serious. First of all, I think it was the first recession that world output fell. And that's indicated in this diagram right here, which comes from the World Bank. So we go from 1990 up to 2012, and you can see at 2008, 9, the economy, the solid black line, drops off. And the dotted red line is the trend growth in GDP for the world economy. Typically, when one country has a recession, not everyone has a recession. Okay? The second one is a comparison with other recessions. This was a bad one. Well, pardon me. Let me go back. I'm going to take 3 first. There have been estimates by the Federal Reserve Bank of Dallas. Low estimate at the end of 2012 was $6 trillion and counting. That turned out to be $50,000 per household. The high estimate was $14 trillion or $120,000 per household. That's the cumulative loss in GDP. And that's indicated right here. The high loss would be the difference between the solid black line and the dotted green line. And then they play around with different trends as a result of the crisis, with most of them being lower. And then compared to other recessions, this is both longer and deeper. That's my third diagram. So the black line indicates going horizontally the length of the recession, going vertically from top to bottom the depth of the recession. You can see that that was a severe recession. Now, these estimates of the loss do not include the deterioration in labor skills, deterioration in mental and physical health. Also, crime rates go up, increased government intervention, so it expanded the balance sheet of the Federal Reserve from something like $800 billion at the end of 2007, and now it's, I don't know, $2-3 trillion. So it really increased the balance sheet of the Federal Reserve. It resulted in substantial budget deficits for the U.S. government. So this was a serious affair. Now, whenever you have a crisis of this magnitude, something has to happen. And the Dodd-Frank Act was, for the U.S., the regulatory response to that crisis. There was a world response which came through Basel III, and they set minimum capital requirements. They raised the minimum capital requirements from the previous Basels, Basel II and Basel I. And they also set minimum liquidity requirements. You had to have 30 days of liquid assets on hand to meet any demands. And the general idea was if banks had more equity capital to absorb losses and more liquidity to ward off runs, the banking system, as well as the shadow banking system, might not have collapsed as they did. Well, in the U.S., it was the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010. That was a comprehensive re-regulation of the entire financial system. I'm asked to talk about the Consumer Financial Protection Bureau. That was set up as an independent regulatory agency within the Federal Reserve. Set up in the Federal Reserve because that's where all the loot happens to be. And they could take up to 12% of the board's budget That's the Board of Governors. That's not the whole Federal Reserve System. But that's a substantial amount. It doesn't have to go through Congress or anything like that. This agency takes over many of the consumer protection activities of all the other regulatory agencies that have been before. The purpose is to administer, implement, and enforce consumer protection laws. Okay. The purpose is to prohibit unfair, deceptive, and abusive practices in the sale of financial products. Now, these are vague notions, and they leave it to this agency, the Consumer Financial Protection Bureau, to actually flesh it out. And that's what they've been doing since their inception. Some specifics. Well, they regulate non-government student loans, and I think the servicing of all student loans. And evidently there's been some suits on that recently in the sense that students have been told, and their parents who've co-signed loans have not been told how they could in fact expand the maturity of the loans if they couldn't meet them. They regulate certain fees, except the interchange fee in connection with credit cards. Card companies are not allowed to restrict retailer discounts for cash payments by customers. They cannot charge foreign exchange related fees or raise rates without first informing the cardholder. And all the major ones were fined over the foreign exchange fees. They just sort of put that into your account without telling you your monthly account. Card companies cannot retroactively increase interest rates except when the cardholder is delinquent for 60 or more days. Most important, though, was what they did to the mortgages. They set a standard for something called qualified mortgages. And there are the points and the relevant points there. Points and fees cannot exceed 3% of the amount borrowed. No interest-only loans, no negative amortization loans, no balloon loans in most cases. They make an exception for rural and agricultural areas. No maturity beyond 30 years. Debt-to-income ratios cannot exceed 43%. Lenders, and here's an important one, lenders must make a good faith determination of the borrower's ability to repay the loan. And I suppose at a minimum that means collecting the income tax returns of the borrower for the last several years. Restrictions on prepayment fees, prohibition of steering fees to brokers for sale of certain high-priced, complicated contracts, and prohibits predatory debt. Now, what's so important about this qualified mortgage? Well, it represents a so-called safe harbor for a lender in the event of a default. And this is not granted to a non-qualified mortgage. They take their chances. So this is strong, strong protection. Besides defining qualified mortgage and the advantages of it, they also regulated payday loans, and they also require the lender there to do an analysis to see whether the borrower can pay back the loan. Limitations also on loan rollovers for payday loans. An interesting story about payday loans. Of course, the benefits of payday loans are they fulfill a need for consumers. There was a study done that looked at the state of Washington where they banned payday loans. They had state liquor stores. They found when they banned payday loans, liquor sales went down. And the closer the payday loan, the closer the liquor store was to the payday lender, the sharper the drop in liquor sales, which I found reason, nothing else. Okay, an evaluation. Well, there's an interesting development occurring. It used to be, in the good old days or bad old days, however you felt about them, that consumer protection was really based upon neoclassical economic theory. That every agent was a rational agent, but they didn't have all the necessary information. And the job of regulation was to provide the necessary information so that they could make a good decision. And a good decision, that would be it. And courts at that time only sued on the basis of fraud. Now, consumer protection seems to be influenced partly by behavioral economics. Behavioral economics and law take the view that not only are agents lacking information, they're also lacking judgment. And maybe we should control the products, financial products, where in fact they could actually do harm to themselves and to the system. So that's a new change that has gone up. Now there's been criticism of what the Consumer Financial Protection Bureau has done, particularly on contract form. People would argue that some of these innovations in contracts really help people. That's absolutely true. Some of them have been helped. But I'll return to that in a little while. How am I doing on time? Okay, okay. Well, okay. Some individuals, I happen to have a brother-in-law who actually got one of these adjustable rate mortgages at the right time during the 1990s, and it really helped him because it spread out the payments over a longer period of time. He was able to buy a better house than he would have had it been a straight 30-year mortgage. But for those people who bought them just before the crisis, they didn't turn out to be such a good time. There's reasons. So the income of the borrower could be increasing, so that's good for backloading the mortgage. They might be expecting a bequest. That'd be another reason. Well, okay, the contract form. Regulation of contract forms, such as qualified versus non-qualified mortgages, will present a friction, and there will be households that are hurt. On the other hand, these complex contracts in the form of subprime mortgages were an important facilitating factor in the financial and economic crisis. I have some, there, yeah. The study by Mayim and Sufi is perhaps the most careful empirical study on this topic to date. And they conclude, and I quote, "The evidence presented here is that low credit score individuals had the largest growth in debt from 2000 to 2007. We also argue that the expansion of credit to low credit scores individuals triggered the mortgage default crisis in 2007. So that's what you have to weigh it against. Some people will be disadvantaged, but $6 to $14 trillion loss and counting in GDP is a pretty big cost too. I think I'll skip that since I only have 5 minutes less. And I think what I want to do is go to well, there is this big philosophical issue about neoclassical theory or behavioral finance and economics. I'll skip that too. What I want to get to is the great contradiction. In this country, we have a social policy to encourage home ownership for all income classes. In other words, give all citizens a stake in the country. And that's important. There's a number of laws that were passed to enhance home ownership for law, and particularly for low income. But another important U.S. economic or goal of the U.S. Is maintain financial stability. Now, the Great Recession, starting in 2007, shows that these two goals are really incompatible. Parts of the Consumer Protection Act, part of that is designed to sort of blunt financial stability and protect the consumer. So we're constantly going back and forth between, do we emphasize home ownership for all, access to credit for all, or do we emphasize economic stability, financial and economic stability? So here's my suggestion. Maybe it's been made already, I don't even know. Set up a government entity to finance home purchases of low-income households, similar to the Federal Farm Credit System, which is a financing program for farms and other agricultural enterprises. Make it a budget line item so that the legislature and the administration, the executive branch of the government, have to prioritize it relative to other competing uses of government funds. In this way, the social policy goal would be attained through fiscal policy rather than through the private profit-maximizing financial system, as is now the case. Low-income subprime borrowers would no longer be in a position to endanger the private, interconnected banking and financial system. What is important is not to try and achieve social goals through the private financial system. I think I'll leave it at that. I have one more slide, and that is, what did other countries do? Well, the UK set up council houses and flats right after World War II, owned by local governments. And then in the 70s, they gave them the option to buy these houses. There are problems with that. They're nice houses, very nice ones in Oxford, I know. Potential problems, reduction in labor mobility was a big one in England. And in the Paris Banlieues, it was racial segregation. Those are other alternatives, but I think with that I'll stop and thank you again. Why was it set up that way? Well, as I said, maybe I skipped it in there was just too many people hurt in that recession. And they started complaining. These contracts are too complicated, and they want something done. They criticized, in particular, the Federal Reserve that did absolutely nothing. So they seemed to always criticize the Federal Reserve no matter what the problem. So they took it away from the Federal Reserve. They took it away from all the other regulatory agencies. Most of them, the SEC, the Comptroller of Currency, etc. In retrospect, I don't think this Congress would have set it up quite that way. They would not have given them such a carte blanche in terms of budget. Congress likes to put their finger on everything, much like my wife likes to do on my spending. So, should they do that over?
If a bank keeps its loans in its own portfolio, why shouldn't that loan be qualified? The bank is consuming all the risk.
No. Even if it's a non-qualified loan. Well, there's something to be said about that. And that's the disadvantage of securitization. I mean, they get a fee for who are making these loans, then they sell them to a securitizing trust. The securitizing trust slices and dices them. Well, who monitors the loan after that? Well, few people have incentive to do that. They're trying to correct that. Do I think that those that hold the loan that should be a qualified loan? Maybe I might go along with that. I think that might be. Most real estate loans are not held. The loans that tend to be securitized are sort of standardized type loans, which are mortgages, student loans, credit card loans, automobile loans, things like that. But business loans, where covenants play a role, they're not typically.
With a simplified mortgage contract, couldn't that exacerbate predatory lending? Or would it be in such plain language that a typical consumer would understand it entirely?
Well, I believe in simple contracts. Should write simple answers to questions. Exams. So I believe that, well, that would be, in fact, I think I make that recommendation, that every mortgage writer should have a plain vanilla contract. Another thing I think should happen is for the more complicated contracts, to just give a time path of payments under variable rate mortgages under maybe two assumptions about interest rates in the future, just so people can see. The complaint was made that people were shocked at what happened to the monthly mortgage payments after the initial low payment period. And better to shock them in the beginning before they make a decision than into the contract. What was the other part of the question?
Or would it be in such plain language that a typical consumer would understand it entirely?
Well, I don't see anything wrong with understanding contracts. That's for sure. In fact, that's the big complaint against, how many of you ever looked at the credit card? I mean, this is a small print, but one interesting thing is they're citing it. It turns out that credit card contracts are written in 10th grade English, and the average American can understand 8th grade English. Whether that's actually true or not, well, there was a study that reported that result. But I do know they are common, and they're long. And of course, the credit card companies come back and say, well, the law requires us to do that.
Finally, a significant portion of the American public believes that our financial or economic problems in this country are driven by the human vice of greed. Among so-called Wall Street banking executives, what response do you have to this explanation?
Well, that was the first part of the talk. Jesus upturning the papers in the money changes. Nothing has changed. They charged large sums for transacting the local currency into the temporal currency. And our bankers are doing that today. What makes it worse is they also have the largest incomes, but they have very, very high incomes. Partly responsible for this skewness in the distribution of income. Maybe behind that question is, do I think anyone should have gone to jail? Yes, Ben Bernanke, the former head of the Federal Reserve, says he wished some would have gone to jail. I think the system is set up that you're allowed to do everything up to what the law states. And I don't know whether in fact there was a case that they put on put someone behind bars for doing that. Much like a trader that breaks the inside trading laws. They're a good case. They can always argue that, we thought we were within the law, and they may have been within the law. So I don't know whether any banker should have gone to jail. That would be information that I serve as an outsider.
We'll be hearing next from Professor Paul Schultz. Professor Schultz is the John W. and Maud Clark Professor of Finance at the University of Notre Dame. He received his BA from Macalester College and his PhD in Finance and Economics from the University of Chicago. He serves as the director of the Center for the Study of Financial Regulation. Professor Schultz's research includes the collapse of internet stock prices, arbitrage, the prices of dual-class shares, and the ability of mutual funds to pick stocks. Professor Schultz.
It seems that we had never met before today, but our remarks are, I think, pretty complimentary, actually. We're going to cover a little bit of the same ground. What I'm going to talk about today is what I perceive as two big changes in the underlying philosophy behind financial regulation, and in particular how they're both reflected very much in the CFPB. Let's see. Thing to advance slides. You know, a few years back, I gave two talks in 1 week. One was at the University of North Carolina, and they did not have a remote, so every time I just switched slides, I'd have to walk over the computer and press the advance button, which is, you know, not a big problem, but I like to walk around when I'm speaking. And 2 days later, I gave a talk at a Morgan Stanley conference in Florida. And they gave me the remote, you know, you just press the button and the slides advance. But what I learned after that was that at the Morgan Stanley conference, when you press the button on the remote to advance the slide, a light flashed in the back of the room and a Morgan Stanley employee advanced the slide. Okay, two big changes in our approach to financial regulation since the financial crisis. First, we've moved away from hard, clear rules toward more regulator discretion. This is not to say we don't still have hard rules, clear rules. We certainly do, and we're making a lot more of them. But regulator discretion seems to be more important than it has been in the past. And second, echoing what Bob said in his talk, behavioral economics has become very influential in regulatory circles, and it's moving us toward more paternalistic regulation. So what I'm going to do in this talk is first talk about the growing influence of behavioral economics and the move away from hard rules toward regulator discretion. I'm an economist, so I'm going to talk about the costs and benefits, or advantages and disadvantages of these changes in our regulatory approach. And I'm going to discuss them in the context of the CFPB, which personifies both of these changes in our approach to regulation, has from its founding. Okay, first, what I mean by hard rules is unambiguous, clear, statements that tell financial market participants either what they must do or what they cannot do. And these are rules that are clear to the financial institutions and also to the regulators. So everybody knows if you're meeting these rules or not. An example is capital requirements. Under Basel III, if you hold certain types of assets, you have to have so much equity on your balance sheet to support those assets. It's clearly spelled out how much equity you have to have for each type of asset. The regulator knows it, the bank knows it. Another example is on insider trading. Insiders are clearly defined. They're officers or directors of a corporation, or owners of more than 10% of the company's stock. If they sell stock, they have forms that they have to fill out and file with the SEC within 2 business days. Again, it's clear who the insiders are. It's clear what they have to do if they sell their equity. There's no ambiguousness about it. Both the regulators and the insiders know what they have to do. Now, as for discretion, here's 2 recent examples. The Financial Stability Oversight Council, which was established by Dodd-Frank, is to oversee the financial stability of the United States. They decide which companies are non-bank SIFIs, or systemically important financial institutions. These are institutions whose failure could cause financial instability for the entire United States financial system. Companies, a lot of the non-bank companies do not want the SIFI designation. It's costly, it brings an additional regulatory burden for them, and so they would like to know what they can do to avoid it, but the FSOC, the Financial Stability Oversight Council, won't tell you what it is. Here's what they say. Due to the unique threat that each non-bank financial company may pose to U.S. financial stability and the qualitative nature of the inquiry under statutory considerations, it is not possible to provide broadly applicable metrics. This is very similar to the famous definition of pornography. We can't define it, but we know it when we see it. And that's what the FSOC says. We can't define a SIFI, but we know it when we see it. Another example of discretion, bank stress tests. Dodd-Frank requires banks to pass forward-looking stress tests based on plausible but unusual economic scenarios. But the banks don't know what the stress test is going to be. They don't know what the economic scenario is going to be ahead of time, so they cannot prepare for that. Regulators instead choose the economic scenario, choose the stress test without telling the banks what it will be beforehand. Now, there are advantages of regulator discretion. Rules can be gamed. You can obey the letter of the law, but violate the spirit. An example from my teaching is I would give tests where I wanted short answers to some specific questions. And so I would say, write the answer in the space provided. Well, people write very, very small. That didn't work, so I said, 2-sentence answers. I'm only going to read the first 2 sentences. Now, people who've never used semicolons in their life are using 2 and 3 in a sentence, okay? So that's the way rules can be gamed. The financial rules can be gamed in the same way. Innovation may make rules out of date. You probably think of ATMs as just an easy way to get money from your checking account, but initially they were also seen as a way to get around branch banking restrictions. Rules are based on a subset of information, whereas the regulator always knows more. They know the specifics of the situation. So giving them discretion keeps rules from being applied in situations when they do not apply. Rewriting bad rules can be a slow process. So if regulators have discretion, They're trying to make sure that financial institutions behave in accordance with various principles. You don't have to worry about rewriting bad rules. So that's another advantage. There's disadvantages too. A big one is that it creates uncertainty for financial institutions. Companies that don't want to be regulated as SIFIs, they don't know how to get out of it. They're not sure if they should divest certain assets. They're not sure if they want to engage in a merger. They're not sure about various aspects of their business because they simply don't know what they can and cannot do without being regulated as a SIFI. I'm going to say it assumes regulators are smarter than they are, and it gives a false sense of confidence. There may be a tendency to say we can't write a good rule for this, so let's just let the regulators decide. Well, if you can't write a good rule, the regulators may have a hard time doing this as well. The Financial Stability Oversight Council, again, is established to prevent another financial crisis. I think that's showing excessive confidence in regulators' ability to spot potential financial instability. It also gives regulators much more power to pursue their own interests. The great majority of people in regulation are just trying to pursue the public interest, no doubt about that. But there's a lot of ways you can also pursue your own interest if you have some power and some discretion as a regulator. If, for example, you want a political career, you can target unpopular financial institutions for various enforcement actions. Get your name in the paper. If you want an industry job, there's a well-known revolving door between Wall Street and the regulatory agencies. So by getting along with investment banks in your role as a regulator, you may ensure yourself a job in the industry when your days as a regulator are over. So there are advantages and disadvantages to giving regulators discretion. I think there's two reasons why we are seeing a move toward more discretion now. One is that financial markets and institutions are much more complicated than they have been in the past. Writing rules is just that much harder. Second is perhaps a political reason, and that is that regulators, be it the SEC or the Comptroller of the Currency, the Fed, have not really gotten much blame for the financial crisis, and in part that's because they were able to say, we haven't had the discretion to do various things to prevent it. So it gives the regulators more discretion. Okay, the second big trend is the growing influence of behavioral economics. Traditional economics assumes people are rational and act in their own self-interest. We all know that they're not always rational, but it's a good assumption that allows you to come up with powerful and useful models. Traditional economists give market failure as a reason for regulation. So for example, bank runs. Everybody can be rational, but if you believe that other people think a bank is insolvent, you have an incentive to withdraw your funds. So even if a bank is perfectly solvent and everybody knows that, just the fear that other people think it's insolvent can create a bank run. Okay, so that's the kind of market failure that traditional economics uses regulation to take care of. A traditional approach to financial regulation is just give investors information. That's what the SEC has been doing since the 30s, right? Make sure that investors have prospectuses, make sure they have current financial statements, and so forth. Behavioral economics has its roots in psychology. Now, in the lab, behavioral economists have documented many, many ways in which people do stupid things. With respect to, well, they can't update probabilities properly, for example. They tend to ignore lots of information and focus on information which may be particularly visible. The way you frame a question when you ask somebody something affects their answer. Even though the information may be the same, when you phrase it different ways, the way in which you phrase it affects somebody's answer. So people are not fully rational, and they do stupid things from time to time. That's behavioral economics. That's starting to exert a big influence on regulation. Behavioral economics says that our approach of giving people information is not enough. They can't process it. Okay, so even if you give investors all the necessary information, they may still make bad decisions. So regulation, in this context, is seen as something that can correct not only market failures, but also personal decision failures. We can use regulation to correct people's inability to make smart financial decisions. It's paternalistic. And to a lot of people, that's a bad word, but it's not seen as a bad thing to many people involved in behavioral economics. Paternalistic financial regulation can make individuals better off by steering them toward choices that are in their best interests. Big proponents of this have been Cass Sunstein and Richard Thaler. Now, they propose a different approach to regulation, which is a little easier to swallow than just paternalism. It's what they call libertarian paternalism. Rather than telling people what to do, we are going to make the best choice, the default choice, and just have them have to work to opt out of it. So, for example, when people are confronted with investment choices for retirement plans, suppose that you give them a choice of 5 funds and they can put their money in any one of the 5 or all the 5. A lot of people have no idea what to do, so they just divide their money equally between the 5. So what libertarian paternalism suggests is people of your age should be 60% in equities and 40% in debt, and therefore we're going to give you 3 equity funds and 2 bond funds so that you'll select the right mix of debt and equity in your retirement funds. It doesn't prevent people from choosing themselves, but it nudges them toward their best choice. And this view has become enormously influential. Academics like myself, we tend to overweight just how influential academic research is, but Cass Sunstein, for example, has headed the Office of Information and Regulatory Affairs in the Obama administration. So people who are writing on libertarian paternalism are directly involved in regulation. Well, big advantage of paternalism is it can protect people from doing certain stupid things. A lot of people have very deep philosophical objections to paternalism. They say that people are better off making their own choices, and that's better for their happiness and welfare than selecting the right credit card. But that aside, just looking at the disadvantages of paternalism in leading to wrong choices, there's a few of those as well. Individuals have more information about their own circumstances than regulators. So what is right for most people or people in general may not be right for a particular individual. And of course, the individuals always have more information about their situation than regulators. Regulators are also subject to behavioral biases. They make mistakes as well. They're also subject to overconfidence. Finally, paternalism can discourage innovation. Financial innovation would slow down if people came up with new consumer financial products but felt that potential consumers would be steered away from them. So it can slow innovation. Finally, what is in theory a nudge, in practice often becomes a hard shove. Okay, rather than just suggesting people move into a particular product, in practice, regulators often end up just making it impossible to get another product. Okay, both of these things, paternalism and regulator discretion, are part of the CFPB right from the beginning and really underlie the CFPB's philosophy toward regulation. The article by Orrin Bargill and Elizabeth Warren called Making Credit Safer is generally regarded as the founding document of the CFPB. They proposed a regulatory agency to handle all consumer protection. If you read this article, there's a very clear bias here. They seem to believe that every financial innovation takes place to make it harder for consumers to understand things. Okay, that seems to be their bias in this article. They compare financial regulation with regulation of consumer products. They say, we regulate toasters because when you buy a toaster, there shouldn't be a 1 in 5 chance that the toaster will explode. But during the financial crisis, people taking out certain types of adjustable rate mortgages had a 1 in 5 chance of defaulting. So throughout this article, the article which laid the groundwork for the CFPB, they make comparisons with consumer products. So just to digress for a minute, I got kind of interested in that. Ladders, toasters are kind of complicated, but a ladder is an example of a very regulated consumer product. It's dangerous, of course, if you fall off the ladder, you can be hurt. OSHA has stringent rules on ladder characteristics. They must support 4 times the stated maximum weight. By the way, this is just a small subset of the rules on ladders. There's many pages of ladder rules. Must support 4 times the stated maximum weight. So if you have a ladder that says 250 pounds maximum weight and you weigh 260, don't worry about it, it's 4,000 pounds. Rungs or steps must be not less than 10 or more than 14 inches apart. The minimum distance between side rails is 11.5 inches. Why 11.5? I suspect it's a compromise between the 11-inch faction and the 12-inch faction. They compromised 11.5. Rungs or steps must be corrugated, knurled, dimpled, or coated with skid-resistant material. Okay, that's what OSHA's up to. There's committees that write these rules. They spent a long time doing it. I'll show you some examples of ladders in practice. You can see the ladder tied onto the bottom ladder. I don't know if you can see the ladder propped against the side there, overhanging the stairway. You have one guy standing on top of the ladder, which you're not supposed to stand on top of, by the way, and somebody standing on his back. And here you have a ladder on the top rung of the lower ladder. Now the point of this is that the problem may not be unscrupulous ladder manufacturers selling cheap ladders to unsuspecting buyers. People are knowingly doing risky things on ladders. With adjustable rate mortgages, some of the people buying houses with adjustable rate mortgages were knowingly doing risky things. It's not clear we should protect them. I think a good case can be made that we shouldn't protect people who are knowingly doing risky things. But anyway, I digress. The CFPB was always intended to have broad discretionary powers. The original article, Bargill and Warren, notes that legislation targeted to specific practices is incapable of effectively responding to the high rate of innovation in consumer credit markets and the subtle ways in which creditors can exploit consumer misunderstanding. So regulators need discretion. One of their examination manuals says, to carry out the objectives set forth in the examination objectives section, the examination process also will include assessing other risks to consumers that are not governed by specific statutory or regulatory provisions. We can look at anything we want for risk to consumers. Okay? Really broad regulator discretion here. And that was the intent from the start. Their mandate is to regulate unfair, deceptive, or abusive products. Now, I know nothing about law. Everybody in this room knows more about law than me, but my understanding is that unfair and deceptive have meanings which have been established through a number of enforcement proceedings with the FTC and elsewhere, but abusive is new. Abusive is not entirely defined. It will have to be defined through regulatory proceedings, and in the meantime, the CFPB has tremendous discretion to pick up practices or products that they believe to be abusive, since it's not well defined. Here's an example of discretionary power. This is not one of the CFPB's finest moments. Auto lending. Dodd-Frank stipulates that the CFPB has no regulatory authority whatsoever over car dealers. It says that explicitly in the bill. There's no good reason for this except the car dealers had good lobbyists. But nevertheless, it's in the bill. But what the CFPB does do is it regulates lenders that work with auto dealers. If you go to get a car loan, or excuse me, if you go to buy a car and you get a car loan, what will happen is the dealer will arrange for it with a bank, and the dealer will mark up the interest rate on the loan they charge to you. March 2013, the CFPB released a bulletin warning lenders that they would be responsible if auto dealers discriminated on interest rates on the basis of race. Okay? But lenders do not know the race of an applicant. The car dealer does, but the lender has no information on that. The CFPB doesn't either, for that matter. What they do is they have a statistical model based, I believe, on geographic location and family name to predict the probability that somebody's of a particular race. And they're going to use that to see whether car dealers are discriminating on the basis of race. So if you're a lending institution and you're doing loans through car dealers like this, you'd like to avoid being sued under this provision. You don't want to be sued for racial discrimination on the lender's or on the dealer's part. So what can you do? Here's where discretion comes into play. The CFPB will not write a rule so that you can get away from being sued. They won't write a rule for a couple reasons. One is that it will expose exactly the methodology they use to predict race, which may be very flawed, and also because they think it would create political problems because, of course, they're not supposed to regulate auto dealers. So here's discretion which creates tremendous uncertainty for people who are lending money for car loans. Paternalism is also baked into the CFPB from the start. Two members of the Academic Advisory Board are Christine Jolls and Richard Thaler, who are big proponents in the academic literature of libertarian paternalism. The term abusive, to the extent that it's defined, seems to be a paternalistic term. The CFPB can declare a product or service abusive if it interferes with the ability of a consumer to understand a term or condition of a consumer financial product or service. It takes advantage of a consumer's lack of understanding of the product, the inability of the consumer to protect his or her own interests, or the consumer's reasonable reliance on the covered person to act in the interest of the consumer. So again, the mandate calls on the CFPB to act in a paternalistic manner. If you read through their website, you'll see all sorts of examples of paternalism. They say credit cards are too complicated for people to understand. We need to make them simpler. briefly touch on qualified mortgages. Mortgage lender wants a mortgage to be qualified. It gives them a safe harbor from being sued. It reduces the risk to a mortgage lender a lot. Now, one of the things you have to do is you have to assess a borrower's ability to repay a loan for this to be a qualified mortgage, and the CFPB has helpfully told banks what they have to look at to see if the consumer can repay the loan. Now, there's paternalism in two ways here. First, the assumption is that the borrower can't figure out whether he can repay the loan, but also a fundamental thing here is that a bank doesn't make money lending to people that don't pay back. Okay? Nobody makes money loaning to people who won't repay the loans. So banks should have a pretty good idea if somebody can repay the loan. It's much more in their interest than in anybody else's to make sure the loan can be repaid. They're better at it than the CFPB is. And giving these criteria just gives extra paperwork, extra burden for the banks. You might, you can be more subtle about it and say, well, we're going to securitize the loan. There's easier ways to deal with that. You can just require the banks to securitize parts of their mortgages, or maintain parts of their mortgages and not securitize 100%. Okay, I'm going to skip ahead since I had the 1 minute left. I would say that the CFPB is costly for the banking sector as it is without paternalism, without discretion. Paternalism and discretion make it more costly. CFPB's examination manual is 924 pages long. That's just their main examination manual. They have others as well. But paternalism and discretion increases the costs even more. Leave you with a quote. Jim Purcell, president of the State National Bank of Big Spring, Texas. I'm quoting him directly, so it's a little bit of a fractured statement here. Dodd-Frank imposes immense regulatory costs upon community banks, costs that are exacerbated by the CFPB's persistently, inherently regulatory uncertainty. As the CFPB's own website shows, its rulemakings are the subject of constant significant revision. And that's when the CFP bothers with express rulemakings at all, instead of regulating informally through case-by-case guidance and enforcement proceedings. Okay, that's all I got. Thanks.
Is Gregory Pullis. Mr. Pullis served as General Counsel of TCF Financial Corporation since its formation in 1987 until 2009. He also served as Vice Chairman of TCF Financial Corporation from 1993 to 2011 and has served as its director since 2006. He received both his undergraduate and law degree from the University of Minnesota, and he is currently on the Board of Governors here at the University of St. Thomas School of Law. We welcome Mr. Pullis.
Well, good morning. I really enjoyed the professors' talks. They were far more professorial, whatever that word is, than I'm going to be. I'm going to be pedestrian because I come from the law side of things. First off, so how many of you are law students? Holy cow. And how many lawyers? Got a few lawyers. Great. And how many of you have taken a class on Dodd-Frank? Oh, good. So what I say, my pedestrian approach won't be in vain. So my talk, I titled it The End of the Beginning. When Connor called me, he said, well, we need you to talk about the impact of the Dodd-Frank Act and the Consumer Financial Protection Bureau. I said, great, I need 3 days to do that. The impact has been immense. I tried to figure out the right adjective. Gargantuan, earth-shaking, seismic. I mean, you cannot overstate the impact of Dodd-Frank and the creation of this Consumer Financial Protection Bureau. And I titled my talk The End of the Beginning. Now, they've been at this for 4 years, and they have achieved some unbelievable results across the board, and yet in terms of what they can do, they really have only scratched the surface. And so I wanted to begin with going over for you the main structure of Dodd-Frank Act and the Consumer Financial Protection Bureau. The Dodd-Frank Act has got all sorts of things in it. A lot of it doesn't pertain to the consumer end of things. We're only going to be talking about the consumer end of things. If you read the Wall Street Journal yesterday, what did it tell us? The rest of Dodd-Frank caused GE to get out of the financial services industry, to sell it to Wells Fargo. But we're going to talk about Title 10 and Title 14. Title 10 is the Consumer Financial Protection Bureau. Title 14 is the cousin, which are the mortgage provisions. Now, hopefully I don't have to use a person behind there to go from slide to slide. Okay, well, the Consumer Financial Protection Bureau, when we talk about what it can do and its authorities, it does things in three ways. First thing it can do is issue regulations. And so it's got a whole set of laws that were assigned to it. Everybody here familiar with truth in lending? Well, truth in lending, that's one of the, what we call the alphabet soup set of laws that were transferred to the Bureau. And so the Bureau, in the first instance, can issue regulations under all these federal financial laws. And so it regulates by issuing those regulations. The second thing it does is it supervises. So you might have a regulation that it's issued that applied to everybody in this room, but the CFPB only supervises this half of the room. That half of the room still has to follow the regulation, but they got somebody else that's making sure they do it. But supervision is another step in what they do. What does supervision mean? It means examination. Now, anybody here work for a bank? All right. Well, when you hear that next week there's going to be an examination, what's the first thing you do? You're scared because they're going to come in and they're going to look at everything you do. So it is a big deal to be supervised by the Consumer Financial Protection Bureau. So that's the second thing they do. And then the third thing they do, and this is what you read about mostly in the paper, is they enforce. They have the authority to issue cease and desist orders. They have the authority to assess civil money penalties. And that authority is separate from the supervision authority and not coordinate with it, and the same for regulation. So these are three separate ways in which these folks do their business. I'm going to now get real pedestrian and talk about, well, what is it that they cover? What exactly are they responsible for? They're not responsible for GE's commercial business. They are in the consumer, the retail end of things. And so the first thing is products. What kind of products? Well, it's pretty near everything. What does the 2-5 mean back there? 25. Oh, 25 minutes. See, I thought blue, green, 2-5. Sorry. So, if it's got to be a consumer, personal, family, or household. So if it's personal, family, or household, and then if it's financial, then they can get their hands on it. Now they've got a list of things, and essentially in the statute, a consumer financial service or product is defined by a list, but then at the end of this list is this grab bag. And I'll go to this one here. At the end of that list, it's a circular definition. So I don't know who wrote it, but if you were in law school, you'd get an F, because at the end, it says, at the beginning it says a consumer financial service or product is, and then there's this list, and then at the end there's this grab bag. It says basically whatever consumer financial services or product the CFPB decides poses a big risk to consumers, essentially. So they can define anything they want as a consumer financial product or service. And one of the things I would emphasize again is they haven't exercised that authority yet, but they can. And so they basically, today there was an article in the paper about the Minnesota AG going after this charitable car thing, where apparently you donate your car and you get a tax deduction, and the AG says, well, they're not telling them the truth or whatever. Well, is that a consumer financial service? Well, it's a consumer, because the person was driving the car. They're getting a personal tax deduction out of it, and taxes are financial. So query whether that would come within the ambit of the Consumer Financial Protection Bureau. In any event, it remains to be seen how far they take this authority going down the line. Now, there are a bunch of exceptions to this. If you had a good lobbyist, you got out of some things. So if you're selling a security, that's not covered by this. If you're selling insurance, that's not covered by this. Those guys have wonderful lobbyists and got exceptions. Okay, so that's the product. Pretty broad, still to be defined. Now the law. So what laws are these guys responsible for? Well, it's something called, and there should be an F in there, or federal consumer financial laws. So it's only federal law that we're talking about here. And it's four things really. First, they got 18 enumerated statutes, so they call them the enumerated consumer laws. Truth in lending, truth in savings, fair credit reporting. Have you guys taken consumer protection law yet? Well, you've got to. If you're going to be in this area, you've got to take that. Well, anyway, there's this, we call it the alphabet soup of federal law, federal consumer law. And the Fed used to be in charge of most of these. Well, those all get in this list of 18 enumerated consumer laws. They become a federal consumer financial law. Then the Dodd-Frank Act, Title 10 itself. Title 10 is where you create the CFPB. You've got this unfair, deceptive, and abusive standard. It's the four corners of what we're talking about here today is that Title 10. And what's so important is that in Title 10, there's this general admonition, general statement to the effect that the CFPB is in charge of protecting consumers. And so, in essence, it's a big deal that the substance of the law is the CFPB is charged with protecting consumers. And then laws transferred by the Dodd-Frank Act. There's another, in a couple of the subtitles, there are some laws that are transferred to the CFPB. So, in addition to those three categories, any bureau rules that are promulgated under A, B, or C constitute a federal consumer financial law. So now we know the what in terms of the product, we know the what in terms of the law. Now the who. Well, who are they going to be doing all these things to? Well, the key concept is a covered person. A covered person is a person, which can be a live person or a company, who offers or provides a consumer financial product or service. It doesn't have to be your own product, by the way. It can be somebody else's product. So if you are offering or providing a consumer financial services or product, you are a covered person. From there, an affiliate, which is, as we know from corporate, you've taken the corporations class. What's an affiliate? Anybody? Controlling, controlled by, common control with. All right? That's an affiliate. If an affiliate is a service provider, that's somebody who provides a material service to a covered person, then they become a covered person. A related person is a covered person. A little bit circular the way this is in the statute, but the CFPB believes that if you're a related person, you're a covered person. And who is a related person? Well, it's fairly broad, and over time we shall see how far the CFPB carries this. But if you're a director, officer, or employee charged with managerial responsibility for a covered person, if you're a controlling shareholder of a covered person, if you're an agent of a covered person, if you're a shareholder, consultant, joint venture partner, or other person who materially participates in the conduct of the affairs of a covered person. Or you're a lawyer. Where are the lawyers here? Raise your hands. Okay. You can be a covered person, also appraisers and accountants, who, if you knowingly or recklessly participate in any violation of any provision of Title 10, or you breach a fiduciary duty. So this concept of a related person remains to be fleshed out. Now, they just brought an action against some debt collectors, world debt collectors or some such a few weeks ago, and they rolled out all these definitions against the people who owned this company. They said they were a covered person because even though they were an individual, they were involved in offering the product. They said they were an affiliate through their subsidiary company because they provided services, and they were a related person because they participated in the conduct of affairs and they knowingly or recklessly participated. So it remains, though, to be seen how far the CFPB is going to take this. If you're out there in the world, it just generally isn't kind of assumed by everybody that anybody connected with a financial institution potentially comes within the ambit of the CFPB. And then a service provider. What's a service provider? If you provide a material service to a covered person, then you become a service provider, and you're subject to that UDAP thing that the professor talked about. So that's the who. Now there's what we call a Section 1036 extender to this. And the 1036 extender, 1036 deals with unfair, deceptive, and abusive. And it says that any person, raise your hand if you're a person. If you knowingly or recklessly provide substantial assistance to a covered person or a service provider violating UDAP, then you come within the ambit of the law. So now there's supervisory role. One big change, I tried to come up with the biggest change from Dodd-Frank, and it's hard to. But one of the big deals that happened, it used to be that if you provided financial services but you weren't a bank, you really got the light touch. If you weren't somebody that offered deposits, you really got the light touch in terms of regulation. Well, one of the big things that CFPB, that the Dodd-Frank Act did, is it brings in the non-banks. The big banks are under the direct supervision of the CFPB. So if you have 10 billion of assets, over 10 billion assets, they come in and they do examinations. Are examinations fun? Who thinks they're fun? Who thinks they're not fun? So, to come in and have an examination from the CFPB is a big deal. The big banks used to have these consumer examinations by their prudential regulators. So if you were regulated by the OCC, they did not only safety and soundness, but they did this consumer thing. Oh, here's coming that card. What's that card going to say?
15.
Wait a minute, you got the 1 and the 5. Now I got it. 15 minutes. I give talks about Rome, and I pick 3 people out of the audience, and at the 15-minute mark, they're supposed to go, "Arr!" You'd be surprised how few of them do it. They forget. So the big banks, to have the OCC before, or the FDIC, or the Fed, to go from that to this CFPB, which is specifically charged with consumer advocacy, is a big deal. But the non-banks, a lot of them didn't have anything. If they could offer consumer loans, and they might not get examined by anybody. Well, one of the big things that happened in Dodd-Frank is those people come under the CFPB. If they're in the mortgage loan business, they're in. They're getting examined. And so as we speak, those people, it's when I say we've only seen the tip of the iceberg, who knows where that's going to go after all these examinations kind of go on for 1, 2, 3, 4 years. If you're a private education loan provider, they're in examining you now on a regular basis. Payday lenders. And then the last 2 are, again, where we're going to see down the line where these people take this thing. If you are a larger participant of a market for consumer financial products or services, they can define you in. And they've done this to consumer reporting agencies, consumer debt collection companies, student loan servicing companies, international money transfer companies, and a big one here is non-bank auto loan business. So the professor talked about how the automobile dealers had a hell of a lobbyist. I remember it at the time. And they got out of this thing. But what they didn't get out of is if they have a finance arm. So we used to think of GMAC and such. Well, those people have now been defined in, I forget what the threshold is, 10,000 contracts a year. They are defined as being subject to the supervision. Big deal. They're going to get an examination every year at GMAC or whatever it's called now. And those finance arms are going to get a regular examination by these people. Then finally, there's a fifth area where non-banks can come in. If the CFPB decides that you are a covered person and you pose a big enough risk to consumers, they can take you within their supervisory authority to boot. Now, to date, I don't think they've done one of these, but I don't remember that they've done one of these. But again, we've only seen the tip of the iceberg in terms of what they can do. Enforcement. So now we move to enforcement. I think, well, what's the biggest thing from this whole thing? Well, I'm not sure. I find this one. It's like, you know, when my wife and I go shopping, okay, we'll decide on this, but then we see that one. No, that one's bigger. No, that one's bigger. So what this is their enforcement to date. I think they state that they have recovered $11 billion through enforcement action so far. They've got over 80 to date. And the big deal again is we're on the tip. We're on the tip of this thing. The SEC does a whole ton of these things. And so the thought is once they get up and running, they're going to have these 20 a month maybe. We're going to be every day in the newspaper. There's 20 newspaper days a month. We'll have one a day. Their staff is going from 6:33 to 7:47. So this is a big deal. We talked about the discretion. Well, this is big time discretion because what happens is they will come in and they will look at what you're doing. And let's say these after products that banks were selling, like a form of insurance was debt cancellation. And so they come in and they say, well, you didn't tell this guy that, you didn't tell Sally this, and you didn't tell Jim that. And then they assume that you didn't tell everybody that. And the bank concedes because they don't want to go through that enforcement process. Huge deal, huge deal. Next, Consumer Complaint National Database. Almost 600,000 to date. There are 20,000 of these coming in a month to this National Complaint Center. And they get logged, and the institution's got to respond to them. They have revolutionized consumer complaint processes in banks. Banks now have probably 4 levels that a consumer complaint goes through. Why? Because they don't want a call from the CFPB that says, we have noticed that you have 10 complaints last week, you know, about X. We're going to come in and look at that. So this is a huge deal, and it's public. And, you know, one of the fears is you get plaintiff class action lawyers. This is their go-to site. All right, so now we're into some more specifics of what has happened. Does everybody kind of understand the groundwork of the who and the what and the how they're going to do it? Okay. So now these are things that have already happened. The ability to repay. People don't realize, you talk about paternalistic, there is a rule of law essentially in the United States of America now that you may not obtain a real estate mortgage unless you can demonstrate that you have the income to repay that loan. And if you state it that way, it seems, what? Let's say you come in and you have, this actually is me being old. I have a small mortgage now on my house, but I don't make any money. And so if I go in and I say I want a real estate mortgage on my house, I got, you know, $400,000 of equity in this house. You don't have to worry. Bank says, I am sorry, you can take a flying leap because you don't have the ability to repay that from your income. And the thought there is that what created this crisis back in '07 that Professor talked about was people were getting loans hand over fist based on the fact that these home values, and I know this happened in North Minneapolis, these home values kept going up. They default on them. They just refi it based on the equity in the property. And as long as the market was going like this and you could sell these to those thieves in New York, everything worked fine. As soon as the property values start coming down, the whole thing unravels. So the rule now is you don't get loans based on the collateral. You get them based on your ability to repay. That is a big deal. Know before you're old. Anybody got a real home mortgage since October 3rd? Well, go try to get one, because it ain't easy. They got something now called TRID. They took the old truth in lending form that Marion and I grew up with, and the old HUD 1, the thing none of us ever looked at when we got our home mortgages. Well, they put them into one, combined it under this know before you owe, and as of last week, whenever they started this thing, the beginning of October, you get that thing, and usually they're sent by mail. You got to wait 7 days before you can get your mortgage. This is a big deal. The combination of those two things, big debate, what's the consequence to this? More loans, less loans? And the CFPB maintains there's no reduction in credit. The Fed just published a study. They claim, look, we can't see any reduction in credit from these. And I say, well then, if there's no reduction in credit, why'd we do it? Obviously there's a reduction in credit, because if we were making loans before that shouldn't have been made, obviously we're not making those today, therefore there's less loans being made. And if you talk to the average banker, the bankers say, of course there are fewer loans that are being made, because now we've got to document all the income, and we can't take a chance on anybody. We cannot take a chance. You go in there and you say, well, listen, I've banked with you for years. I'm Greg Pullis. I never defaulted on a loan. I'm so wonderful. Make me a character loan. Listen, you see that door? Get your ass out of it. We're not making you any loan. Ability to repay going forward. So in my mind, there's no question that credit's going to be restricted. And unfortunately, who's going to not get the loans? It's protected classes. Because when we go out in the street, do we think that African Americans and Hispanics have less income on average than whites? Well, if that's a demonstrated fact, they're going to be more impacted by this. In the banking business, and Professor talked about this, the conflict, we have something called the Community Reinvestment Act in the banking business. You must make loans in the city in census tracts, low to moderate income census tracts. But you cannot make any loan that they don't have the ability to repay, so they get it coming and going. This is going to be a big impact going forward, and only time will tell what actually happens. Prepaid cards. So if you go buy a gift card in the future, the CFPB is going to regulate you. Consumer reporting agencies, a big deal, the accuracy. Right now, I have no idea whether the level of accuracy at the consumer reporting agencies. What junk goes in, junk goes out. So there's just zillions of reports being made. This is a big deal for the CFPB. That's going to be a big deal. Debt collection, that ranks #1 in those customer complaints they get. That's going to be a big deal. Student loans, they're going after private for-profit colleges. And you say, well, that's not a consumer financial product. Well, there's loans involved. And so they're kind of regulating those people by saying, you guys didn't tell the truth about your graduation rates. 5 minutes. You didn't tell the truth about your graduation rates. Therefore, you engaged in unfair deceptive practice. Okay, redlining. A little bit first, we talked about the car dealers. In America, we have something called buy rates. Anybody ever heard of buy rates? But what that is you go to the car dealer and you say, I want to buy this car. And say, okay, I'm going to finance it. The dealer says, okay, the rate is 15%. And you might say, okay, I take it. Or you might say, no, not good enough. And then the dealer will negotiate that down. And they can negotiate it down all the way to what's the buy rate. What's the buy rate? That's the rate the bank says it will buy that contract from that dealer at. That's the buy rate. That's how it's been done forever in America. Well, the CFPB says this is discriminating against protected classes. How do we know this? It's some Bayesian system that they use because they don't know the race on these contracts. But they can tell Greg Pullis he's got to be Dutch. Because I looked on the data, and Pulis is Dutch. They all come from Eindhoven. That's where I'm from. And furthermore, I can tell from his address, he lives in Plymouth. And so based on the demographics, they can look, and so now they can say this contract was to an African American, that contract was to an Hispanic, that contract was to a white person. And then they look at the rates, and they match pair these. So they find this guy's got the same income as this guy, as that person, they got the same assets and the same credit rating, they're all the same. But guess what? The African American paid a higher rate. The deal, they didn't get the same negotiation that the white guy got. So that is a big fight going out there, and they can't get at the dealers themselves, but they can get at the bank that's buying the contract. Enforcement action 2 weeks ago, Fifth Third, Allied Bank. I mean, they're all caving on this through these enforcement actions. Redline. Another big deal for the CFPB. They enforced the fair lending laws against those people that we were talking about. And here, they just went out after a bank, I think it was in Boston, and they're saying that a bank has an affirmative duty when it puts its branches out there, when it does its marketing, to see to it that you're reaching majority-minority census tracts. That's going to be a big deal. And again, the big fight is, well, wait a minute, I don't discriminate. If I'm a shoe manufacturer, I put one where I put the store where I can sell the shoes, and the demographics will tell me where that goes. Well, banks, they look at the demographics, so they put their branch in Edina, whatever, and they don't put one on Broadway Avenue in North Minneapolis because they look at the profitability and can't make a buck doing that. Well, the CFPB says, I'm sorry, you have an affirmative duty to reach out to majority-minority census tract. This is going to be a big deal. Mandatory pre-dispute arbitration. How many of here are going to be plaintiff class action lawyers someday? If so, leave the room. No. But if you're going to be a plaintiff class action lawyer, last week was a banner week for you. Why? Because the CFPB announced that it's going to ban class action waivers in arbitration agreements. So up to this point, if you've got a cell phone contract or something or whatever, all these things, a deposit contract, generally you'll have a mandatory pre-dispute arbitration clause that you can opt out of at the beginning. It basically says, we agree, 1 minute, we agree we're going to arbitrate this thing, and I agree that I can't bring a class action. Well, the CFPB says, sorry, those are going to go by the boards. That in and of itself is a huge decision because the exposure to class action suits is a big number for banks. It's a big number for financial institutions. It's a big number for any business in America. That's a big deal. Regulatory burden. And I'll finish with this. What is the regulatory burden of all this? Big, 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 bigger. So, I asked fellow bankers what's going to happen in America. They said, well, we're going to end up with 5 banks by the time we're done, just like Canada. This is Minnesota. This is the number of chartered banks in Minnesota. That's where it's going. 5% down a year in the number of banks. Why? I mean, it's impossible. It's like we talked about banks like Certainty or financial institutions like Certainty. They don't like this abusive standard. This abusive standard, I have no idea what it means. You can read the definition in the statute, taking unreasonable advantage. Well, what does that mean? Bottom line is that the regulatory burden, you guys have made, who's going into compliance? You have made the right decision. Ask for more money. That's what I tell you, because they're going to need you. Because it is, I'm on the board of this little bank. Well, they went from 1 person to 2 persons. Well, that is a big deal. And I remember Richard Davis at U.S. Bank says, well, we're not hiring anyone except in compliance. We're doubling that. He actually didn't say that. Words to that effect. So the regulatory burden for all this is immense. Only time will tell where this law takes us and where the CFPB takes us. But again, I can't come up with adjectives that describe the immensity of it. This is the biggest thing. I've been doing this for 40 years. I wasn't around for deposit insurance, but that's the last biggest law, federal deposit insurance. This thing is unbelievable. So with that, I would stand for questions.
What advice do you have for students or recent grads entering the market with significant student loan debt? How can we best protect ourselves?
Well, if you wait long enough, Congress will say you don't have to pay it. Besides that, and I can't tell you, well, why did you get the loan? I can't say that. They're really, I mean, as we move forward in the student loan servicing, apparently, and I don't know this, I don't know that business well enough, but apparently there are all sorts of errors being made. And the CFPB is all over it. And so I would do two things. One, I would read everything the CFPB issues on student loan servicing. And two, I would fly-spec my documents, your lawyers, fly-spec those documents, fly-spec the laws that apply to that loan and the regulations that apply to that loan, and find out what they're not doing that they're supposed to be doing, and file a complaint with the CFPB, join the other 20,000 people this coming month.
Do the FDIC insured banks have any retaliation options against the CFPB?
No. No, they don't. I'm sorry. I wish I had something for you. And believe me, I mean, the CFPB has done a lot of good. When you read some of these cases, and you say, well, they shouldn't be doing that. And those, in large case, a lot of those are, you know, the non-banks that never had anybody looking over their shoulder. So, but really, one thing you could do if you had you know, the wherewithal to challenge the constitutionality, there still is a case pending. And you know, if this were common law, it would be a terrific question. The director is appointed by the president, and they only be removed for basically malfeasance. There is no commission to which the director answers. The appropriations, which is the most constitutionally suspect provision, they get a chunk of the Fed's money every year, and it's specifically in the law that the appropriations committees of the Congress cannot review that funding. Well, that, you know, folks would say it's the subject of this constitutional challenge case, violates separation of powers. You can't put somebody outside of the reach of the appropriation. How can you do that? I thought those cases were in charge of the money. So if you were of a mind in an FDIC insured bank, join that lawsuit. There was a serious discussion about the constitutional challenges early on, but nobody had the wherewithal, you know, to step forward and to make those arguments. There is this one case that had been dismissed on standing grounds and was just reinstated. So whether that will go anywhere or not. So that is one thing, you can join that case.
What are some of the advantages or disadvantages of their current reach?
Well, the advantage of their current reach is, you know, that they can address situations that weren't being addressed before. I think it's great that, got nothing against payday lenders, but I think it's great that they are subject to the supervision of the CFPB. I think there are many other of these situations that have been addressed by CFPB make perfect sense. It does trouble me. We are moving, we talked about that ladder. Well, that's us. That ladder is us. The CFPB can now regulate all consumer financial products from cradle to corporate grade. And so we're going to have financial ladders. This ability to repay, I personally believe in 5 years they will rewrite that, because they'll say it's having too negative an impact on lending. Particularly when it gets tested is when you go into an economic downturn and there are people that don't have, their income to go. So, I mean, my own personal view is the reach is too broad. That's just my personal view. Yes, Mr. Mariner.
Yeah, I read a few years ago, a lot of mortgage providers found themselves in royal waters over the so-called robo sign.
Over the what sign?
So-called robo sign.
Robo sign, yes. Robo signing is where the lender, when they're foreclosing, they run the papers through a machine and a robot signs it.
So my question is, a lot of folks in the bar back then were talking about how this possibly, where does this derive from? There's no regulatory expectation. It's almost a non-regulatory compliance expectation. It's almost like an operating risk, not even an operation risk. Can you see the Bureau extending the UDAP concept to something like a non-regulatory compliance expectation such as
Absolutely. I mean, you think about what they could do. That is a slam dunk. Yeah, sure they can. But what if tomorrow this is an extension of what you're talking about now, because that one's an easy one, yes. But what about if tomorrow they come up with, for all deposit fees, they must be reasonable and proportional to cost. Talk about the ladder. That's what we have with debit interchange. But that is where the consumer advocate groups would like banking to go. Reasonable and proportional to cost, and they do that. Last week, Richard Corderay, the director, talked to the credit union folks, and he talked about access to banking accounts. They are very big into the payment systems. And going forward, what they want to see is if you're poor and you have some source of income, the banks have to give you access. And so those frontiers are more challenging to me than robo-signing. Robo-signing is given. Okay. Thank you.
All right. Our next speaker is Ms. Joanne Barefoot. Ms. Barefoot is the current CEO of Joanne Barefoot Group in Washington, D.C. She serves on the Consumer Advisory Board of the Federal Consumer Financial Protection Bureau and is also a member of the board of the Center for Financial Services Innovation. Ms. Barefoot was the first woman deputy comptroller of the currency and was also the first leader of the agency's Startup Consumer Protection Unit, enforcing consumer, civil rights, and community reinvestment laws at all national banks. So, Ms. Barefoot.
Thank you. I'm just delighted to be here with you today. I was so pleased when Connor Marinan invited me, and I'm especially happy to see my dear friends, Tim and Patty Marinan. Tim and I were partners in business and have done more regulatory compliance work than we want to remember at this point together. And I was thrilled with your framing of the program today, the shield and shackle, and I'm adding a sword to it. I think that there's a very important contest emerging here between the industry, the regulators, and the innovators using regulation in all of these important ways. I'm going to talk with you, though, first, not so much about the regulation as about the technology. I'm going to, how many of you, a lot of you are law students, how many of you are planning or might plan to be working in financial law? Okay, well, I want to offer a perspective to you to suggest that we are on the early stages of a complete transformation in how consumer financial services are going to be done, and therefore how they're going to be regulated. And I thought I would start with a story as we think about the changes underway, because I'm going to be talking about keeping up with technology. So I'll tell you a little personal story. I was in a meeting not long ago and got a text from my daughter who lives in London, and multitasking on my many devices as we do these days, I took a look at it and I burst out laughing. Everyone at the meeting stopped and stared at me, and I had to tell them that my daughter had written, "Mom, Dad is trying to post pictures to Facebook and it is going badly." And she said, "It's so entertaining, so funny." I got his permission to share this story because anybody of my age or Tim's age has been in this situation. How are we going to keep up with all of his technological change, which is about to change the lives of financial consumers profoundly, for better and for worse? So I want to share 3 key points with you today in my talk. The first is that technology is in the process of disrupting the financial services industry, as we have seen with other industries, from Blockbuster to publishing to photography. But the thing that people are underestimating is that because financial services are so highly regulated and have such a complex, pervasive regulatory system around them, this change is going to disrupt the regulatory system as well. Our regulatory system is going to bend and break and have to be remade because of the stresses that are hitting it from technological change. The second point I want to make is that the regulators and the disruptive innovators are actually attacking the same things about traditional consumer financial services. They are both looking for every place where the businesses benefit, knowingly or not, from consumer confusion, inertia, lack of education or transparent information, product complexity, lack of good access and choice, or where costs are high because of the legacy costs of the system. And they're both planning to knock all that down. Different motives, different methods, but the industry is going to be in a pincer attack from both the regulators and the innovators at the same time, and it's going to bring a lot of change to it. And the third is that, therefore, banking law and regulation is going to be profoundly changed by these forces that are ahead. We are going to find that the whole regulatory mechanism is going to be forced away from sort of the compliance rules-based technical alphabet soup that we're accustomed to now, and into a world that's going to be way more uncertain, requiring much more thinking and interpretation. I'm going to make my presentation with a lot of graphically, visually dense material for you, because I want you to engage your right brains as well as your left brains in this, because I think that's going to be what is going to be needed to do well in this field going forward. This is Solon. He banned debt bondage in Athens in 680 BC. So for as long as people have had debt, they've had problems with it. Governments have been trying to fix it. If it was easy to do that, we would have figured it out by now. These problems are very intractable. And in the United States, we've been trying to solve this problem for a long time, mainly through 2 methods. One is consumer education. We've been trying for a century to foster financial literacy at the federal level, and through consumer protection regulation. We have, especially with disclosure, but a massive amount of consumer protection law and regulation, proliferation over 50 years, really, ever since about the time Ralph Nader wrote his book, Unsafe at Any Speed, and sort of launched our modern consumer movement. We've had more and more buildup of law and regulation aiming to protect people, often overwhelming people. I have my fingerprints on a lot of this myself. I worked for the Senate, was a regulator. I have to say, I think the main thing that we've accomplished for consumers in most of this is we've just bored everybody to death. And the effectiveness of it is so much under question. These are numbers from American Express, which has a film I recommend to you called Spent, talking about the people who are not included in mainstream financial services today, don't have good access even though they have jobs and so on. And the high fees they pay, the difficulties that they have accessing the system that we have now. And then on top of this all, for all the effort we're doing, we still aren't doing a good job of protecting people. We've had this spectacular failure is shown in the financial crisis, and really in area after area. We find that people don't understand their financial services. They are in terrible trouble with it. And so it makes you ask yourself, might there be a better way? So in the wake of the financial crisis, Congress asked that question, and they came up with a solution, the CFPB. I have just finished a 3-year term on the Consumer Advisory Board to the CFPB. I know them very, very well. I've spent hundreds of hours with their top people. I think, as Greg said, they have done a lot of important things very, very well. And I'd be happy to talk maybe in the question period if you want to understand them more. I'll tell you, I've been in Washington for, I hate to say quite, like 40 years or so, Tim, and in and out of Washington. And there's never been a critter like the CFPB before. It's a completely unique agency. It's becoming more normal now, more bureaucratic for sure. But it's really unique in the scope of powers, in the way it thinks of itself, in the mission, and so on. On the other hand, you say to yourself, this is a congressional solution. I realize I'm in a room full of lawyers, but still. We have a problem, and Congress says the solution to this is let's reorganize the government. You know, that hardly ever gets us very far. And then the second thing they say is our regulation has been failing to protect people, so let's do more of it. Let's just like regulate them harder. And maybe somehow this next group of people will get more out of the regulatory effort than the last group did. At the margin, that makes a difference. They're definitely nibbling at the edges of this problem. But at the same time, something more important is going on, which is that technology is attacking it also and has the potential to swallow some of these problems whole and change the entire way it's going to need to be regulated. So I'm going to try to fly through 5 drivers of disruption. I'm about to get my time count back there, I can see. And then talk about what this means for the regulatory process. I'll try not to elaborate on any of these too much, but just imagine this future for a moment. What if you could say to your cell phone, could I get a better credit card? And your phone would say to you, well, let me take a look. First, I'm going to screen out all the products that have tricky hidden terms and fees that might be deceptive. And then I'm going to evaluate the way you use your card specifically. And I'm going to look at consumer complaint numbers and consumer ratings on these cards. And I'm going to suggest these 2 to you. And would you like to talk about the questions that you have on them? And that future may seem very distant and hard to picture now, because it's coming to us in 5 huge technology trends, each of which is enormous, but which are in the process of converging and have not yet merged. And I'm going to describe each of them quickly and then encourage you to think about what happens as they hit each other and work together. The first one is big data. We know that data about us is being collected now from all kinds of new ways, new sources, things that we aren't used to thinking of as being known about us. We know our social media activities are being checked. We know that geolocation knows where our cameras know where we are, our phones, our cars know where we are all the time. That's being used to triangulate us. We know that the Internet of Things is collecting information on us. 6 months ago when I would speak to banking groups, most of them had never heard of the Internet of Things. But this is all the little computers that are embedded in the smart devices around us, from our cameras and our baby monitors and our TVs and our fitness bits, trackers and Apple Watches. and our smart refrigerators and washing machines that we're about to get and our thermostats, they know what we're doing, who's doing what, when, what our habits are, and they talk to each other and they talk to outside parties, and they're getting a very complete picture of us. And also facial recognition technology. How many of you have Google Photo? So Google Photo can see us, you can say, find me the pictures of me with my dog, and or find my pictures of Tim Marinan and his dog, and it can go find them for me. Screens are watching us, big screens and little screens all the time. Are we smiling or frowning at something in a store? What are we doing? Who are we? Where are we? All of that is being rapidly collected. And then we have also government data. These are from the CFPB complaint database that Greg mentioned. That really the whole federal government is committed to making public data a national resource, making it easy through an API interface for everybody to get all this data and put it to use. And an important thing about big data is that it's a big driver for inclusiveness, because it's creating alternative data about people who may not have a conventional credit file or a good credit score, but may have credit worthiness nevertheless, that you can figure out if you're using different kinds of data to evaluate them. So this is a transformational thing, but it is also a problem because big data is big. It's messy, it's complicated, it's often inaccurate, it's not collected to have precision accuracy. And that's where the second trend comes in, which is artificial intelligence. So the advent of machines that can not only process information, but can actually think as we do. You hear these terms, machine learning, neural networks, deep learning, about the ability of computers today to understand what it is we're trying to figure out and go figure it out for us through trial and error, learning as they go from our reactions to it. We're accustomed to knowing that these big computers can beat us at information games. We know that, this is a quote from one of these new so-called robo-investors, taking a little swipe at Schwab for being an old firm that's bolted together, whereas with artificial intelligence today, they think they can do a better job of analyzing stocks. Goldman Sachs has bought a company called Kensho, which can answer millions of investor questions in seconds in plain English text. You say, what if a Category 5 hurricane hit the mainland United States? What would happen to the price of home building stocks? And it answers it instantly. We know that, again, that these big computers can beat us at chess and Jeopardy and so on. And we also know that they're diagnosing disease. Something that interests me as actually a cancer survivor is that these machines can go out and have been asked by researchers to look at pathology reports and have come back and said, well, here's what we found, but we also noticed this thing in the tissue outside the malignancy, and might that be interesting to you? And it was, but the human researchers had not thought to ask for it. IBM has even asked Watson to start to look at whether it could undertake actual creativity by asking it to invent recipes. Hope you like that animation. I made that myself. And to try to invent foods that would put together ingredients we would never think to put together and get them to make them both taste great and be nutritious so that we would eat what we should eat instead of what we feel like eating. And maybe end something like obesity, even though Watson, of course, can't taste food. Again, these are huge forces for inclusiveness in the ability to serve more people with more precision and finely tuned approaches. The third is voice technology. How many of you talk all the time to Siri? How many of you talk all the time to Cortana? How many have asked Siri what she thinks of Cortana? I have. I asked Cortana. She said, I'm glad Siri and I now have Bing in common. I was in a hotel room a few days ago working, and Cortana kind of activated on my computer, and I said, Cortana, what are you doing? And she said, I'm working out the details of a virtual fist bump. Part of the point of which being, they're funny. They're trying to engage us by bringing these amusing personalities to us. Voice technology is the big democratizer. I have been predicting this for a long time, and I feel quite vindicated that the current issue of Wired magazine has an article on this that I really commend to you, the October issue, about the speed with which this is coming. I don't have time to really talk about it now, but this is going to make us bring our financial services the last mile to where the consumers actually are, the consumers who don't know how to go online and try to understand the way we present financial material today. And it's going to be completely, it is transformational, and it's already starting to be. I would recommend that you Google this, SoundHound Hound. A lot of you know SoundHound as a music recognition technology. There's a video online on YouTube, not the product demo, but the poor quality video of the inventor asking his phone these questions. Hound. It will boggle your mind. What that phone can answer in listening to voice and bringing him those answers. And it's today, this is not in the future, this is already here. Translating between languages, between voice and text, and then also developing them. The breakthrough is natural language technology that's bringing the artificial intelligence into the voice so that people can talk with their smart devices. Fourth issue, obviously, is online and mobile. We know that most banking is already done online, and that people are using their online services for most of their financial tasks, taxes, paying, buying things, and so on. And for getting information about products that they might want. And also, though, for managing our lives in new ways, for our fitness trackers, our mobile devices, there's never been anything like it in the history of the world. They are mediating between us and practically everything in the world. I get my daily meditation from my phone, there's nothing they aren't doing for us, hardly. And this is changing the way we live, and it's consolidating information in the phone. And again, it's a huge, huge driver of inclusiveness, because people don't understand that lower income people and communities of color are disproportionately high users of smartphones. It's because they skipped over the whole digital divide PC generation, which was expensive, and went straight to the mobile phone. These are Fed statistics on the very, very high usage in what we consider underserved markets. And if we bring the phone to them as their financial services intermediary, all of a sudden everything changes in terms of expanding access. And also the phone, I'm pointing to my watch when I say the phone, my Apple Watch, is consolidating our financial information in one place and putting it in a computer that's got incredible power, so that people will be able to get it all together and understand what we have instead of having it spread all over the place. Absolutely revolutionary, especially for millennials. Last but not least, just a quick touch on the blockchain. How many of you have studied the blockchain? Nobody. Okay, well, so the blockchain is the invention of Bitcoin. Bitcoin may or may not live to be a keeper over time. My son works at Circle Financial, which is a Bitcoin company, and he likes to say that when he tells people what he does, they say, "Isn't that the drug thing?" But Bitcoin invented the blockchain. I'm going to tell you, it's going to revolutionize the law, because what it has done is create a transparent, open ledger on the internet that is recording any series of transactions. It can be the movement of money, it can be the movement of titles, records, contracts. There are thousands of companies around the world working on Bitcoin 2.0 technology to disrupt stock markets, because the chain is visible to everyone. It's on the internet. It's free, it's instant, it can't be duplicated, it can't be faked. It's profoundly changing how people work. So all of this is converging, as I say, and as it converges, the power in all of it is going to be much bigger. In the interest of time, I won't tell you my whole story about why I have an Xbox, but I'm sure you're thinking how amazingly cool I am that I do have one. The short version of it is that I actually have it because I'm so uncool that I sometimes am challenged by my TV remotes, and I would call up my poor beleaguered son on a Saturday night when he was on a date, and I would say, Matt, I can't watch my movie, you know, I've got 3 remotes going. And he says, you need an Xbox. I said, why would I need an Xbox? I've never played a computer game in my entire life. And the answer is because it can, I can control it with my voice. And so these technologies, 4 of the 5, have already converged in my living room. I talk to my Xbox, I exercise with it, it's seeing me, it's listening to me. There's a lot of interesting privacy issues there, but especially if you'd see me exercise. But this is now that these things are coming to us and about to get incredibly better. This is Gordon Moore, the inventor of the Moore's Law concept that says the computing power is doubling every 2 years. He said that in 1975. And this is what that looks like. In 5 years, you get 32 times more computing power. In 10 years, you have 1,000 times more. In 20 years, you have 1,000,000 times more. In 50 years, you have 1,000,000,000 times more. We are living now on the vertical part of that curve, and we're not wired for it. We are wired for linear, and we're living in this exponentially changing environment. I recommend the readings of Niv Jor if you haven't read him. And all of this is hitting us in financial services at the same time. So this is disrupting finance. Already, we're well underway with it, and a lot of things are going to change. This is a picture of Wells Fargo's website, and you could pick any big bank and tell the same story. It's showing a few of the companies, just a fraction of the companies, that are using innovation to attack different components of what is offered today by a full-service bank. There's nothing that a big bank is doing today, or a small bank, that is not being challenged by innovators who are trying to figure out how to do it better, smarter, faster, cheaper for the consumer. So if you think of Uber, and I live in the city and live with Uber all the time, these are some of the things that's been, I made a longer list the other day, 15 things that problems that Uber had solved, and I realized like 7 of them were things we didn't even know were problems until Uber solved them, including this playfulness that they have. You know, they're engaging and funny. So I'm going to walk you through, and I'll refrain from developing each of these, but if you turn this around and you put the consumer at the center instead of the businesses or the regulators, put the consumer at the center, and ask yourself, when you think about consumer protection regulation, what are the things that cause consumers financial difficulties? And I want to illustrate for you that all of these causes are being worked on by both the regulators and the innovators. Let me ask you a question. What kinds of things get people into financial trouble? Overspending, that's the first one on my list. Good. What else? Lack of education, great. Any? Poor planning, super. Okay, so it's a cluster of interrelated things that happen to people that get them into trouble. And again, they're all being disrupted by both regulators and innovators. And the first one is overspending. A former bank examiner friend of mine who's retired sent me this the other day. Tim, this was Alan Dombrow. I'm going to retire and live off my savings. What I'll do on the second day, I have no idea. This is where people are. We tend to overspend. We are bad at saving. We don't think long term. And so people are working on this problem with incredibly creative new approaches. This is an app called meetcarrot.com, which focuses on trying to get us to do the things that we don't do very well for ourselves. And they call their exercise app your judgmental fitness overlord. And it insults you and calls you names and tells you to do things. You're going to be able to set your coach in your phone and give it an avatar, give it the personality you want. Maybe it'll be your nagging mother, or maybe it'll be a kitten, or whatever it is that you respond to that can be your little coach, reminding you of what to do, helping you remember that when you're walking past the Starbucks, because remember, it's got the geolocation, it knows where you are, that you've already spent your budget there this week, and maybe you should just walk on by, just saying. People are also inventing now what I'm calling the Uberization of savings. I used to think that to get people to save, we had to get them to be mindful and think about their goals and all of that, and that's still really important. But people today are saying, forget all that, and let's just make the savings effort disappear from our lives and just happen for us the way when we get out of an Uber car, there's no money changing hands or documents changing hands because we've already set it up, right? So I know some amazing young developers who are saying, you don't have to struggle with how much should I save, what kind of vehicle, what's a 401k. Just say, tell us how much money you make. We'll start to save for you through your app. You can adjust it as you go. You can get the money back later. Let's get going with it. And people are finding that they can save, and then they get interested, and then they get hooked on it. Second one is disrupting product complexity. These are all interrelated. I've sort of arbitrarily separated them. Greg mentioned that the CFPB is trying to simplify disclosures. They put out this new TRID integration of some of the laws, which are trying to simplify what the consumer sees. The regulatory scheme behind that is massively complex. But the CFPB is trying to do that, but so are the innovators. I have a podcast series called Barefoot Innovation, and I'm going to show you the faces of some of the innovators I've talked with. This is Josh Rich and Shamir Karkal of Simple, BBVA Simple. And they have invented a very simple account that, among other things, will, when you open it and look at it, instead of telling you what your balance is, it tells you a number called Safe to Spend. And you've already taken out of that what you need to pay for your rent and so on, and what you want to save. They are very funny, interesting people. They invented this because Josh hated his bank. He hated it, and they're technology people. Third, disrupting boredom. The simple people are extremely funny. If you listen to my podcast, they say something quite inappropriate. This is a picture of Professor Dog, who is the mascot of Green Dot Bank in California, and the dog of Steve Street, the founder of Green Dot. And Steve Street was a DJ, and he started a financial company in prepaid cards, and their goal is to keep it simple and to keep it on your side. In my interview with him, he said, I want you to think of us as being like a dog. He said, we'll make mistakes. Maybe we'll pee on the carpet from time to time. But he said, we want you to know that we'll never knowingly harm you. We are always going to be loyal to you. Very different from the way people think normally about their banks. Fourth, disrupting the expense of the system. A lot of the lack of access is just that people can't afford the cost structures. This is Renaud Laplanche, the founder of Lending Club, which is matching borrowers and investors, bypassing the banks and using good data and analytics to try to analyze the risks involved and give people better pricing. This is a man named Steve Carlson, who's invented a startup in California called Ascend, which will make loans to people who would normally be charged a high rate. And then if you pay back well, they will give you what they call rate rewards. They'll cut your interest rate by as much as 50% during the life of the loan if you have a good record of paying back. This is Luz Urrutia from Opportune, figuring out how to serve Latino and immigrant markets. This is a man named Yi Li of Vouch. Don't even know what Vouch is? Greg referred to character lending. Yili is trying to bring character lending into the 21st century by saying that they will give you a better rate if your family and friends online, your social media connections, will vouch for part of your loan. They say, who knows you better than your friends do? Maybe they know you better than your FICO score does. And if they're willing to back you and pay if you don't pay, I'm willing to give you a better rate. It's a very interesting company. And just the mobile technology itself is so cheap compared to, say, bank branches. It's demolishing the cost structure of financial services. Number 5 is disrupting the problems that come from delay and volatility. We know from increasing research that a lot of people have enough money to pay their bills, but they don't have it at the right time because they have volatile income and expenses. And a lot of people are working on solving that problem. The CFPB is trying to work on it by regulating both payday lending, and next to come will be bank overdrafts, which are high-cost solutions that people turn to for these timing problems that they have. But meanwhile, mobile payments and a lot of these other technologies are just speeding up the payment process so that people are not going to have so many problems with the lags. I'm on the board of the Center for Financial Services Innovation. We are holding a $25 million 5-year contest funded by Chase. And the first group of winners this year all invented solutions to this volatility and timing problem. There they are. This is Manolo Sanchez. He's the CEO of BBVA Compass in the United States. And I wish I had more time to talk about him. He's been a banker all his life. He's the biggest innovation evangelist I know. And one of the things he says is, suppose we'd said to people, we're going to take your emails and batch them up and send them out at midnight every day, once a day. Nobody would put up with that, and yet that's what we put up with our payments today. And technologies are working on speeding this up across the board, including through Bitcoin-based companies. This is the CEO of my son's company, Circle, which is making it possible to move money in seconds for free everywhere through technology. Disrupting deception. We know that all these factors we're talking about can turn into outright deception and manipulation of people. All the regulators, especially the CFPB, are cracking down on this through UDAP, as we said. But bigger than that is that we've moved into an era where the consumer is evaluating the businesses just as the businesses are evaluating us. And business models that depend on deception, I think, are going to be under extreme difficulty. This is Susan Ehrlich. She was the global head of consumer credit for Amazon. And one of the things she told me is that they have a credit card and they just put it up on the Amazon site like it's a pair of socks for everybody to put star ratings and comments on, totally transparent, and learn from it. And this is how we live today. We're rating everything we're seeing. All of this data is going to be aggregated. These are pictures of my son's. My son took of his food to evaluate it and put it online. We're moving into an era where businesses are going to know everything about us, and we're going to know everything about them also, and it's going to completely change the power equation. Last but not least, just disrupting confusion. This is Richard Davis of US Bank. In my podcast with him, he wanted to go to talking about the trust issue undermining the banking industry and how the industry is going to need to rebuild that by regaining people's trust. The CFPB is working on the confusion problem with all sorts of efforts. So are outfits like NerdWallet. But if you think about it, if people with no medical expertise can invent machines that can find cancer, how sure are we that people need financial literacy to have a healthy financial life? Yes, we wish everyone was financially literate, but again, we've been trying for 100 years and people aren't financially literate, are they? This is going to be solved through technology. Josh Rich from Simple, I put up there before, and I were talking about financial education, and he said something I've never forgotten. He said, it used to be that to drive a car, you had to understand how it worked, figure out how to engage the gears and so on. And then they invented the automatic transmission, and you could pretty much get in the car and drive it. And now we're going to have driverless cars, for heaven's sakes. So the technology is creating tools that are going to enable people to get good choices. So this is going to bring a lot of difficulties to the industry, a lot of extinction of practices and products and some players. And for the regulators, it is going to be a challenge like nothing that has ever been seen before. It's going to be literally impossible to get all of this right. If we think about it, what we want from regulation in a post-disruption world, it's going to need to be faster, it's going to need to be more flexible, it's going to need to be able to change with this quick change in the technology in the marketplace. Apparently somebody said earlier the industry is going to need certainty, you're going to need consistency, all of that's going to need to come together and be reliable, and that's not going to happen. I mean, you can't have all that together. You can't have clarity and flexibility, and you can't have certainty and quick change. You know, it's simply going to be impossible for the regulators to do all that. Consumers are going to struggle. We're going to have increased problems in cybersecurity, in privacy. We're going to have branch closings. Branches won't disappear, but they're really going to disappear from a lot of people's lives who are counting on them. The bank regulators are going to have to struggle incredibly with the difficulty of how the bank charter fits into this complicated value chain that we're talking about. We're going to have backlash from the regulated industry. This is taxi drivers protesting Uber. We're going to have huge problems of fairness and discrimination. Should you have to pay more because of what you like on Facebook or how many friends you have? A lot of innovators are finding that very predictive, but is it fair? The regulators have nowhere near begun to figure out what to do about that. And then there's the issue of just the proliferation of the people that are doing this innovation. You know, the regulators can't even find them. You know, you can write an app and have customers before we even know what's happening. So people will be struggling with this, and the regulators will as well. I'm nearly out of time. I like to say to people, what big thing happened in 2007? And bankers will say the financial crisis, but that's the year the iPhone was created. And ever since then, the regulators have been too busy to think about it and to figure out how to regulate what is becoming a moving kaleidoscope rather than a steady situation. So what to do about it? Consumers don't feel shielded. The banks feel shackled, but they will be using regulation as a shield. The innovators feel shackles unless they don't know what is coming to them, which some of them don't. We have this incredibly complex system. We have 5 separate financial bank regulators. I counted 25 to 30 federal consumer financial product agencies in one form or another, multiplied times 50 states, et cetera. They have old missions, they have weak skills, they have 19th and 20th century sort of footings under them. The CFPB is doing a lot of work in this, particularly with their Project Catalyst. And then in addition, the other bank regulators are making moves in this direction. The OCC has set up a task force on financial innovation. I'm interviewing the controller of the currency, Tom Curry, in November for my podcast. And the Fed is holding the first ever financial innovation and regulation conference next month in San Francisco. So I'll close by offering these as lessons to lawyers to think about, to get used to working with this fast-changing environment with a rise in focus on principles and conduct rather than the rules that we're used to convince your clients that they need to stop thinking about compliance as something that you delegate to the lawyers and compliance staff and IT people and understand it to be strategically central to the challenges facing your company, to get used to working in the white space between the regulatory islands where there's going to be risk but no rules to follow, and just learn how to follow them with good principles. To understand innovation yourself and stay close to it, and I would encourage you to work in fintech. It is going to be the future in terms of the industry and I think the legal and regulatory stuff as well. Here's my podcast. It's free. I hope you'll listen. And I'd love to take questions. Yes, that's a great question. Yes, they all have drawbacks. This is the nature of innovation, is that it always brings good and bad things mixed together. If you think about it for a minute, you can't find exceptions to that. And so every single good thing I described here is going to bring bad things too, and it's going to be the job of the regulators to figure out how to let in the good and keep out the bad. And that's going to be the hardest piece of it. I don't think it was said. I'm now at Harvard. I'm a senior fellow at Harvard writing a book on innovation and regulation. And what I'm trying to do is create both recommendations on process, but also principles to help regulators figure out how do you get that right? How do you let the good in and keep the bad out, because they're so intertwined. What was the last part? Great question. And someone did their homework and read my Forbes article. That's great. Yes, I think the company Bitcoin is questionable. May or may not be a long-term provider, but it's unleashed something into our environment in this blockchain technology that is definitely going to stay and change things. And I do think digital currency will both evolve as an alternative to the current payment system, and it's already also changing the conventional payment system. All the central banks in the world are interested in Bitcoin, including the Fed. The automatic payment clearinghouse, the ACH, Automated Payment Clearinghouse in the US, is trying to learn from what these Bitcoin-based payment systems are doing. And I have no doubt that it's going to speed up and simplify and take cost out of payments. It's going to disrupt the remittance market incredibly. Why should people have to spend, huge amounts of money to send something around the world when it can be done almost for free? And it's going to be regulated for sure. My son's company is the first one that got the brand new New York State BIT license. It was a gargantuan compliance undertaking to make that happen. He's the head of compliance there, maybe I said that. And the regulators are trying to figure out how to allow this to flourish without killing it with regulation. And it's going to be difficult. Also, Bitcoin is a mold breaker. It's partly a currency, it's partly an investment in store of value, and it's partly a payment system. And so the regulators don't even know where to put it. You could say the same thing about marketplace lending, for the peer-to-peer lending. The people don't know where it fits into our regulatory system, and that causes all kinds of regulatory confusion. We're going to have to get used to living with that. I think big data poses tremendous threats to liberty, certainly in the hands of the government itself, the Snowden controversy and so on, in terms of how big data are used. And then in terms of private companies using it, I think we're just at the beginning of trying to think that through. If you regulate the use too tightly, we won't get the benefits. I mean, if we go online and are asked whether we agree to our new iOS update or whatever, we press the button, I agree, right? And you're giving them permission to do all sorts of stuff with your data. But if you say, I don't agree, you can't use anything. We're going to have to find a middle ground where there's more granular power for the consumer over how things use, or certain things are just banned and put off limits as uses. But on the other hand, if you give the consumer too detailed a set of choices, nobody's going to bother trying to do it. They're just going to say, I agree. So we are at the very beginning of figuring out these profound privacy issues because the use of big data is going to bring us good things and bad things mixed together, for sure. But I do think also that the technology is going to be built to protect us from some of it. We're going to be able to there's a concept in medicine called a smart membrane that lets in the good stuff and keeps out the bad stuff. We're going to have more and more tools like that where we can say, I'm not going to do business with that company because I know they have a terrible reputation for their data security or how they allow data to be used. I'm going to work with this one over here. Microsoft doesn't sell my data that they collect from me. Thank you.